Thank you very much, Abs, for sending this through. As I said, he's bought 4 units in Sydney, and that was his mistake. Okay, so let's unpack that and have a look at what's happened over that time. So I don't know when exactly you purchased these, but also don't know exactly which suburbs you're talking about, but we're going to be using Sydney CBD as an example here because it is quite a volatile unit market, and we're going to go and show a little bit more about what that is. So 2021, we were sitting at a valuation around 1.06 million, went up to about 1.2 in 22, and then we came down to a val of now sitting at about 940k at the median. If we have a look at what's happened in the stock and days on market correlation here, in that time, the property stock and market and days on market were a little bit more tight, sitting at the 48 days and about 102 units on market at the time. Over that time, that's increased, and obviously increased of days on market and stock on market creates a bit of a saturation indexation here, where you've got now 205 properties for stock on market, sitting at around an average of 72 days on market. Now, the increase of stock and days on market is a very direct correlation to there not being enough demand inside the market, and therefore not being enough competition to drive the equity up for the valuations of those properties to increase. Over that same time period, a large decrease of rental listings has come through to the market, and it's currently sitting at about 1.5%. That's against the historical 6.4%. So in 2021, sitting at 6.4%, today we're sitting at 1.5%. So there's definitely a much bigger demand for properties to rent inside the market. And that is a very strong connection to there being a massive housing unaffordability crisis on our hands, where people are just clearly not being able to purchase properties because there's just no demand for purchasing, as we can see, but there is a demand for rentals. And so that correlation of rental return has come forward. Now, not very handsomely, might I say. We were looking at a $990 a week in rent. It's only sitting now at a $1,050 a week in rent valuation increase over that time period, which is a very, very small increase. But it is quite interesting to see that the yield is obviously an increased yield, which is over that time period, which is very rare today in the current property stock on markets and time on markets and daily markets environments, where you expect to really see an outperformance of the yield being a declining yield because the valuation increase is so much higher and faster and more aggressive than the rental increase. But obviously the unit market in Sydney CBD is just not showing us that. What is interesting also, though, is that the affordability ratios were sitting quite high during those times, at around 44% for buying, 45% for buying, and 38% for rental. Now sitting at quite a little bit lower at sort of 38% for both. This is telling us that there's a relaxation in the market, and obviously as time goes by, new salaries come into these areas, which then start to play a part against the valuations of those properties, so creating a little bit more affordability. But more importantly, and quite impressively here, is that we're actually looking at, rather lack of impressibility, is that we are looking at a stagnation of value growth inside the unit market for a 1-year forecast, only hitting at around 7.9%. But again, I say that because we're expecting a decline at that stage, coming back down to only a 1.4% and 1.4% for year 2 and 3. Only then starting to, after the relaxation, come back up to an aggressive 30% increase in year 4. So this is kind of a connection between what we're expecting with the housing policies that are going on in place, not in Sydney CBD, obviously, because there's no houses here, but in the other areas where development will start to play a factor of more properties becoming available, according to the government. And this is obviously policy indication, influence data as well. But if the properties do go ahead and we do start to see enough access and option come forward into the metropolitan areas and suburbs outside of CBD Sydney, then potentially there's going to be a movement of properties, or rather units, buyers and renters moving into those areas until the population starts to catch up in year 4, when we start to see that increase come forward. Direct correlation here for the units renting prices as well, with a slow increase of 3.8%, just a smidge below the national average, but then increasing quite dramatically up to year 3, at a 27% increase of rental price growth. Now, obviously, we know that there's a lot of legislation around that, but this is more of a demand indication around how much rental increase and activity there will be at that time. Guys, if you want us to unpack your property markets and you want us to unfold a little bit more around what Crystal's saying and the predictions for your markets, drop those markets in this comment and we can unpack those for you guys on the next Explainers.